The price you're seeing isn't real. Listen, I need you to understand something right now before we go any further. I've been analyzing physical silver markets for 12 years, and I'm watching something this morning that I've never seen at this scale before. Not in 2008, not in 2020, never. While you were checking your phone at breakfast and seeing silver crater to $105.92, something else was happening on the other side of the planet that the financial media isn't telling you about. The Shanghai Gold Exchange closed their session with silver spot at $132.45. Let me say that again, because this is the entire story. Western exchanges are showing 105. The East just closed at 132. That's a $26 gap, not a 26-cent spread, $26. And right now, every financial news outlet in the West is running the same narrative. Silver bubble bursts. Speculative mania comes to an end. Return to sanity in precious metals. They want you to see that red candle on your screen. They want you to feel that stomach drop when you check your portfolio. What they don't want you to see is the $25 premium that's holding firm across Asia. What they absolutely don't want you to understand is why physical silver is disappearing from the market faster than at any point in modern history while the paper price is supposedly collapsing. Because here's the thing, if silver is really crashing, if this is really a bubble popping, then why can't you buy a single physical ounce anywhere in the world right now for less than $125? Think about that for a second. The price you're seeing on your brokerage app, on Bloomberg, on every financial website, that number is a phantom. It's a picture of silver. It's not actual silver. And the gap between the picture and the real metal is about to break the entire Western pricing system. I'm going to be very clear about what I believe is happening right now because the next 48 hours are critical. This is a manufactured paper smash designed to hunt liquidity and force liquidations ahead of the 1:30 p.m. Eastern options expiration today. This isn't speculation. The pattern is too clean. The timing is too perfect. We had a vertical move to $117, then Shanghai goes offline for their session break. And in those exact hours, while Eastern markets are closed and can't defend the floor, Western paper markets get hit with algorithmic selling that drops the price $12 in less than 3 hours. And it all happens to bottom out exactly 3 hours before the largest monthly options expiry we've seen in years. You cannot tell me that's a coincidence. What we're witnessing right now is the final stage of a decoupling. The Western paper market for silver has officially separated from physical reality. The contracts being traded in New York and London are no longer pricing actual metal. They're pricing a derivative of a promise to maybe deliver metal at some theoretical future date. Meanwhile, the physical market in the East isn't playing that game anymore. They want metal. They're paying $132 for it, and they're taking delivery. Here's what I'm going to show you in this breakdown. First, I'm going to explain the exact mechanism of what's called arbitrage dislocation, which is the technical term for when paper and physical prices divorce. Then I'm going to run the stress test math on COMEX inventories that shows why the bullion banks are absolutely terrified right now. And finally, I'm going to share my personal battle plan for positioning through the next 2 days. Because this isn't just another trade. This is the end game for price discovery between a failing Western paper system and a physical hungry Eastern market that stopped trusting Western pricing 6 months ago. But before we can understand why this morning's smash was so critical, you need to understand the trap that was set for every silver investor last night. All right, let's pull this apart slowly, because once you see this mechanism, you can't unsee it. In a healthy, functioning market, the price of a contract for silver and the price of an actual ounce of silver should be basically identical. Maybe you have a small spread for storage costs, insurance, that kind of thing. But we're talking cents, not dollars. When those two prices separate significantly, the market is broken. It means something has fundamentally failed in the price discovery process. I want you to think of it like this. Imagine there's a car dealership that sells pictures of Ferraris. Beautiful 8x10 glossy photos. They're selling these pictures for $20,000 each. And right across the street, there's another guy who's selling the actual keys to real Ferraris for $30,000. For a while, a lot of people buy the pictures because they're cheaper. They're easier to store. You can trade them quickly. Some people even convince themselves the pictures are basically the same as owning the car. But here's the question. What happens when everyone shows up at the dealership at the same exact time and demands their actual keys? What happens when the dealership has sold 5,000 pictures but only has 50 cars in the back lot? That's where we are right now with silver. The COMEX price, the price you see on your screen, that's the picture price. That's people trading contracts back and forth, most of them with zero intention of ever taking physical delivery. The Shanghai price, the $132 number, that's the keys price. That's people who want actual metal in their actual hands. And the $26 gap between those two numbers is telling you something very simple. The dealership is running out of cars. The paper sellers, the bullion banks who have been writing these contracts for decades, they are absolutely terrified of physical delivery right now. Because the entire system was built on the assumption that most people would just trade the pictures back and forth forever. Nobody was supposed to actually demand the keys. But something changed in the last 6 months. The East stopped playing the paper game. They started demanding delivery. And now the math doesn't work anymore. Here's why this matters specifically today. This isn't just a theory I'm spinning for a video. The data from this morning proves the dealership is running out of inventory in real time. I was looking at the COMEX data a few hours ago, and I need to show you exactly what I'm seeing. At 10:20 a.m. Eastern this morning, COMEX silver was trading at $105.92. At that same moment, the Shanghai Gold Exchange had closed their morning session at a spot equivalent between $128 and $132, depending on which contract you're looking at. Japan was showing $135. The Middle East was trading around $128. So you have this bizarre situation where every physical market in the world has silver priced between $125 and $135. But the Western Paper Exchange has it at $105. Now, here's what makes this absolutely insane. January 2026 is not a primary delivery month for silver. It's what they call a quiet month. Historically, January sees very light delivery activity because most of the major contract rollovers happen in March, May, July, September, and December. But this January has already become the 6th largest delivery month in COMEX history. As of this morning, we had 9,529 contracts standing for delivery in January. That's 47.6 million ounces of physical silver being demanded in what's supposed to be a quiet month. Let me put that in perspective. In January of 2024, we had less than 2,000 contracts stand for delivery. In January 2025, it was around 3,000. This year, 9,529. And we're not even done with the month yet. Now I want you to stop for a second and ask yourself a very simple question. If silver is really worth $105, if this morning's drop was a legitimate price discovery event reflecting true market value, then why can't you find a single physical dealer anywhere in the world willing to sell it to you for less than $125? I'm not talking about small local coin shops. I'm talking about major bullion distributors, large-scale refineries, international trading desks. Nobody is selling physical silver for $105. Nobody. The paper price says one thing. The physical reality says something completely different. And that gap, that dislocation, is the entire story of what's happening right now. The algorithms can push the paper price wherever they want on the screen. They can trigger stop losses. They can hunt for liquidation levels. They can create red candles that make you feel like you made a terrible mistake buying silver at $90 last month. But they cannot make physical metal appear out of thin air. They cannot force Eastern buyers to sell at Western prices. And they absolutely cannot solve the fundamental supply deficit that's been building for 3 years straight. The paper price is whatever they say it is. The physical reality is what it is. And right now, those two things are further apart than I've ever seen in my 12 years watching this market. Now, of course, there are skeptics who have a ready-made explanation for all of this. Let's address their argument directly, because it's important to understand why they're wrong, what the skeptics are saying. The mainstream narrative right now is pretty straightforward. They're saying the run to $117 was pure retail FOMO, speculative mania, people buying silver because they saw it going up, not because of any fundamental reason. And they're saying this morning's drop to 105 is just a natural correction. Margin calls forcing leveraged speculators out of their positions. Maybe some dollar strength helping to push metals down. They'll point to the DXY showing a bit of a bounce this morning. They'll talk about profit taking after an extended rally. They'll use words like consolidation and healthy pullback. And look, I'm not going to tell you that margin calls aren't part of what happened this morning. Of course they are. When you have a vertical move like we just had, there are absolutely going to be over-leveraged traders who get squeezed out when the price reverses. But here's what the skeptics cannot explain. Margin calls explain volatility. They explain rapid price movements. They explain cascading liquidations. What they do not explain is a $25 regional premium that holds firm through the entire correction. Think about what would happen if this really was just a speculative bubble popping. If the $117 price was purely driven by irrational FOMO, then the physical premium in Shanghai should have collapsed first. That's how bubbles work. The most overheated part of the market, the place where people were paying the highest prices, that's where the selling pressure should show up first. But that's not what happened. Shanghai didn't blink. The premium didn't collapse. If anything, it widened slightly as Western paper markets were selling off. That tells you something fundamental about where the real demand is coming from. This isn't retail traders in New York panic buying silver because they saw a Reddit post. This is sovereign buyers, institutional allocators, and large-scale physical accumulators in the East who have made a strategic decision to own metal regardless of short-term paper price volatility. The other thing the skeptics like to say is that silver is just another commodity, and it's following normal commodity market dynamics. That's a fundamental misunderstanding of what's happening in precious metals in 2026. Silver isn't just another commodity anymore. It hasn't been for at least 2 years. It's being accumulated as a monetary hedge by central banks who no longer trust the dollar system. It's being stockpiled by governments who see the writing on the wall for fiat currency debasement. It's being taken out of the liquid market by buyers who have zero intention of selling it back at any price in the foreseeable future. When you treat silver like copper or aluminum, you miss the entire story. This is monetary metal being removed from circulation at a time when industrial demand is also exploding because of solar panels, electric vehicles, and grid infrastructure. So let me recap where we are right now, because this is the critical 60% mark of understanding what's happening. Here's what we know for certain. The COMEX paper price dropped $12 while Shanghai was closed and couldn't defend the floor. We have a record-breaking delivery month happening in what's supposed to be a quiet period. The smash happened exactly 3 hours before the largest monthly options expiry we've seen in years. And physical metal is trading at a $25 premium to paper contracts across every Eastern market. Those are facts, not speculation, not conspiracy theory. Facts. And now I'm going to show you the math that explains why the bullion banks are more terrified right now than at any point since 2008. All right, let's run some numbers that Wall Street really doesn't want you thinking about. We're going to start with a conservative scenario, then we're going to run the stress test that shows you exactly how fragile this entire system has become. Right now, we have a $26 gap between COMEX paper price and Shanghai physical price. Let's say that gap closes by only half. Not all the way, just 50% convergence. If we split the difference between 105 and 132, that puts COMEX at $118.50. That's not some wild speculative target. That's just the market finding equilibrium between paper and physical and only getting halfway there. But here's what happens if COMEX does move to 118 in the next 48 to 72 hours. Every single trader who sold this morning's dip is now underwater. Every stop loss that got triggered at 108 or 110 is now a losing exit. Every short position that was open to fade the bubble is now deeply negative. That creates what's called a short squeeze. Traders who bet on lower prices are forced to buy back their positions at higher prices, which pushes the price even higher, which forces more short covering, which creates a feedback loop. And that's the conservative scenario where the gap only closes by half. Now let's run the stress test. We have 9,529 contracts standing for delivery in January. Each contract represents 5,000 ounces. That's 47.6 million ounces of silver being demanded for physical settlement this month. In a quiet month, in January, which historically sees less than 10 million ounces of delivery demand. Now, the current COMEX registered inventory, the stuff that's actually available for delivery, is sitting at roughly 65 million ounces as of last week. That sounds like plenty, right? They could cover January delivery and still have 17 million ounces left over, except February is showing early signs of even higher delivery notices than January. And March is historically one of the biggest delivery months of the year. If the current trend continues, if we see another 9,000 contracts stand for delivery in February, and then potentially 15 to 20,000 in March, you're looking at another 100 million ounces of demand over the next 60 days. But they only have 65 million ounces total in registered inventory right now. The math doesn't work, even if you factor in some contracts getting rolled forward or cash settled, even if you assume some inventory transfers from eligible to registered, the drain rate is unsustainable. This is where it gets really interesting. Let's say the bullion banks see this math too. Obviously they do. They have better data than we do. They know exactly how thin their inventories are. What do? They can't magically create more physical silver. Global mine production is basically flat. Recycling rates haven't meaningfully increased. The silver that's being taken off the market by sovereign buyers and long-term stackers isn't coming back. So their only option is to break demand, to scare people away from taking delivery, to create enough volatility and uncertainty that traders choose to roll their contracts forward instead of standing for delivery. And how do you break demand? You create a violent price smash right before options expiry that makes everyone question whether they really want to be holding this position. That's what this morning was. Now, let me show you the force majeure math, because this is the scenario that keeps bullion bank risk managers awake at 3 in the morning. Force majeure is when an exchange declares they cannot fulfill delivery obligations due to circumstances beyond their control. It's the nuclear option. It's never happened in modern COMEX history, but The math is starting to point toward it becoming a real possibility if this delivery trend continues. Current registered inventory, 65 million ounces. Projected delivery demand through March, if current trend holds, approximately 130 million ounces. Shortfall, 65 million ounces. Even if you assume aggressive inventory management, transfers from London, emergency leasing from central bank reserves, you're still looking at a potential gap of 30 to 40 million ounces by the end of Q1. That's not a rounding error. That's a systemic failure of the pricing mechanism. And here's the thing, these numbers are conservative. I'm using official exchange data, which notoriously understates the real demand picture because it doesn't account for off-exchange physical buying, dealer restocking, or sovereign accumulation programs. The real supply deficit is almost certainly larger than what the official numbers show. So when you see silver drop $12 in 3 hours on a Monday morning, and the financial media tells you it's just a bubble popping, I want you to remember these numbers. $105 is a pricing error of historic proportions. It's the paper market trying desperately to defend an indefensible position against physical reality. The gap between what the screen shows and what actual metal costs is telling you everything you need to know about which number is real and which one is a desperate manipulation attempt. When the math breaks this badly, institutions don't just lose money, they change the rules. What's coming in the next 48 hours? So what happens next? Based on 12 years of watching these markets, I can tell you exactly what the institutional playbook looks like when they're in this kind of corner. First, expect margin requirement hikes. This is the classic move when an exchange wants to cool down a hot market. They announce that traders need to post more collateral to hold their positions. On the surface, it sounds reasonable. Increased volatility requires increased margin for prudent risk management. What it really means is forced liquidation for anyone who doesn't have extra capital sitting around. It's a way to shake weak hands out of the market without actually addressing the underlying supply problem. I wouldn't be surprised to see COMEX announce a margin hike in the next 24 to 48 hours if the price stabilizes above 110. Second, watch for position limits. This is where they start restricting how many contracts any single trader can hold. Again, it sounds prudent on the surface, preventing excessive speculation by limiting concentrated positions. What it actually does is prevent large buyers from accumulating enough contracts to demand significant physical delivery. It's a cap on the ability of the market to price in the real supply deficit. If we see position limits announced this week, that's a massive red flag that the exchange knows they have an inventory problem they can't solve. Third, and this is the one I'm watching most closely, look at the EFP spreads, exchange for physical. This is the premium that physical metal trades at relative to paper contracts. When EFP spreads widen dramatically, it means the people who actually own metal are demanding a huge premium to part with it. Narrow EFP spreads mean the market is functioning normally. Paper and physical are basically interchangeable. Wide EFP spreads mean the market is breaking. People don't trust that paper contracts can actually be converted to metal. Right now, EFP spreads are already at multi-year highs. If they blow out another 20 or 30% in the next few days, that's not just a dislocation, that's a bank run in slow motion. Here's my dashboard for the next 48 hours. These are the specific levels and indicators I'm watching. First, $103 support. This is the technical level that's been holding since early this morning. If this price holds through the 1:30 p.m. options expiry today, it tells me the shorts are trapped. They pushed as hard as they could and they couldn't break support. That sets up a violent snapback rally, probably targeting 115 to 120 by end of week. If 103 breaks and we see follow through selling to 98 or 95, that's a different situation. That means the liquidation pressure was real and there's more forced selling to come. Second, watch the Shanghai Premium overnight tonight. If it widens further, if we see 135 or 140 when Asian markets open, that confirms the Eastern floor is rising regardless of what Western paper markets do. If the premium narrows back to $15 or $20, it means some physical sellers are stepping in and the dislocation is easing. Third, track the delivery notices for January. We're at 9,529 as of this morning. If that number jumps to 10,000 or more by Friday, it confirms that physical demand is accelerating into this price weakness. And here's the thing I need you to understand about what we're really watching right now. This isn't a market correction. This is the controlled demolition of the Western pricing mechanism for silver. The paper price can go wherever they need it to go in the short term. They have the algorithms. They have the leverage. They can create whatever red candles they want on your screen. But they cannot solve the physical deficit. They cannot make the Eastern buyers go away. And they cannot stop the mathematical drain on COMEX inventories that's been accelerating for 3 months straight. Every day this continues, every week that passes, with record delivery numbers and widening regional premiums, the paper system loses credibility. And at some point, not today, Maybe not this month, but at some point in 2026, the market will simply stop believing that COMEX prices are real. When that happens, you don't get a correction. You get a full systemic repricing where physical silver jumps $50 to $100 overnight and paper markets are left behind. That's the scenario we're heading toward. The only question is timing. So given everything I just laid out, what am I personally doing right now? I want to be very clear that this is not financial advice. This is what I'm doing based on my analysis and my specific situation. I'm not selling a single ounce of physical silver that I currently hold. Not 1 ounce. I don't care if the paper price goes to $90 tomorrow. I don't care if COMEX shows a red candle that makes it look like silver is collapsing. Because I understand that the price on the screen is not the price of actual metal. And I'm not holding paper contracts that can be manipulated. I'm holding physical ounces that the Eastern market is currently valuing at $130 plus. In fact, if we get another washout and the paper price dips toward $100 due to continued manipulation ahead of March delivery, I am actively looking to add to my position. That might sound crazy to people who just watch the charts. Why would you buy more of something that's dropping? But if you understand the mechanism we walked through earlier, if you see the arbitrage dislocation and the inventory math, then you understand that a move to $100 while Shanghai is trading at 135 is possibly the best buying opportunity you'll see in your lifetime. It's like finding that Ferrari dealership that's selling keys for $30,000 while they're simultaneously selling pictures for $15,000. If you have the cash and you understand what's happening, you back up the truck. Here's my conditional logic for the next week. If $103 holds through today's options expiry and we see COMEX reclaim 113 by Friday, I expect a violent snapback rally targeting 125 to 130 by mid-February. That doesn't mean I'm selling at 130. It just means I'm watching to see if the paper market can sustain any kind of meaningful rally or if we get another smash attempt. If COMEX fails to reclaim 113 by Friday and we're still grinding around 105 to 108, then I'm preparing for an extremely volatile delivery-driven squeeze in March. That's the scenario where the bullion banks run out of time and inventory simultaneously, where the gap between paper and physical becomes so wide that the exchange has to either allow a massive price spike or change the rules entirely. Either outcome is bullish for physical holders. Either the paper price rallies to meet physical reality, or the paper market loses credibility entirely and physical trades at a permanent premium to paper. Now, I need to say this clearly. These are my personal triggers based on watching this market for 12 years and understanding the specific dynamics of this moment. Your situation might be completely different. You might have different time horizons, different risk tolerance, different capital allocation needs. But what I can tell you with absolute certainty is this. The $130 floor that Shanghai has established is real. That's not a manipulated number. That's actual buyers paying actual money for actual metal. The 105 COMEX price is the manipulation. That's the number that doesn't make sense. That's the number that requires you to ignore physical premiums, delivery demand, and inventory data. I'm betting on physical reality over paper fiction. And every data point we have right now confirms that physical reality is priced at least $25 higher than the paper manipulation. The clock is ticking toward 1:30 p.m. Eastern right now. Options expiry happens in a few hours. If you're watching this video within the next 6 hours, pay very close attention to how the price behaves into the close and immediately after expiry. If we see an aggressive rally back toward 115 after the options expire, that confirms this was a manipulation to maximize profit on short call positions. If we see continued weakness, it means the liquidation pressure is deeper than just options games, and there's real forced selling still happening. Either way, the physical premium in the East is not going away. The delivery demand is not going away. And the inventory math is not getting better for the paper markets. The reality they can't hide. And let me bring this all together because we're running out of time before the market shows its hand. Here are the facts. Not my opinion, not speculation. The verifiable reality of what's happening right now. The paper price hit $105 while physical markets in Shanghai, Tokyo, and the Middle East were trading between 128 and 135. We have the 6th largest delivery month in COMEX history happening in January, which is supposed to be a quiet month. The price smash happened exactly 3 hours before the largest monthly options expiry we've seen in years, at the exact moment when Eastern markets were closed and couldn't defend the physical floor. COMEX registered inventories are draining at a rate that, if continued, makes delivery obligations mathematically impossible by end of Q1. Physical dealers worldwide cannot source metal at anywhere near the 105 paper price. Those are the facts. Everything else is interpretation. But when you have this many data points all saying the same thing, the interpretation becomes pretty straightforward. The Western paper pricing system for silver is failing in real time. The market is bifurcating into paper fiction and physical reality. And the gap between those two worlds is now so wide that even mainstream financial media is starting to notice, even if they don't understand what they're looking at. Here's what I need you to understand as we close this out. Do not let a 5-minute candle on a screen steal your generational wealth. I know it's psychologically difficult to watch your portfolio show red when the market opens. I know it feels terrible to see a $12 drop and wonder if you made a massive mistake buying silver at 90 or 100. But that feeling, that psychological pain, is exactly what this morning's smash was designed to create. They need you to doubt yourself. They need you to sell your physical metal at paper prices. They need you to believe that the screen number is real and the physical premium is somehow fake. It's the opposite. The screen number is the manipulation. The physical premium is the reality. The East has set the floor at 130. They're not buying the paper dip. They're buying actual metal. And they're willing to pay 130 plus for it, regardless of what comic shows. The West is trying to find the exit from a paper system that promised more metal than physically exists. And every day that passes, every week of record delivery demand, every widening of the regional premium, the exit door gets a little bit smaller. I've been in this market for 12 years. I've seen manipulations before. I've seen coordinated smashes, margin hikes, media fear campaigns, all of it. But I have never seen a dislocation this severe between paper and physical. I have never seen Eastern markets simply refuse to acknowledge Western pricing to this degree. And I have never seen comics inventories under this much stress in a non-crisis environment. Something fundamental has changed in the last 6 months. The Eastern markets have decided they no longer trust Western price discovery for precious metals. They're setting their own prices based on their own supply and demand dynamics. And right now, their price is $26 higher than the price you see on your screen. That gap is the story. That gap is everything. This situation is moving faster than the normal news cycle. By the time the financial media figures out what's actually happening, the trade will be over. If you want to understand exactly how this ends when the vaults hit zero, if you want to see the detailed analysis of the March delivery trap that I didn't have time to cover in this video, go watch my deep dive breakdown that I'm releasing later today. I walk through the exact historical precedents for exchange delivery failures, the mechanism by which comics could declare force majeure, and the 3 specific scenarios for how this resolves over the next 90 days. But right now, in this moment, here's what matters. The price you're seeing is not real. It's a paper artifact of a dying pricing system. The premium you're seeing in Shanghai, Tokyo, Dubai, that's real. That's actual metal changing hands at actual prices. One of these numbers is going to win. One of these pricing mechanisms is going to establish the real market value for silver in 2026. I'm betting on physical reality. I'm betting on the number that represents actual metal and actual vaults being sold to actual buyers. And based on everything we've covered in this breakdown, based on the delivery data, the inventory math, the regional premiums, and the timing of this morning's manipulation, I believe we're watching the final chapter of the Western paper-silver market. This isn't the end of silver. This is the end of the fiction that silver is worth whatever number appears on a comic screen. The metal is worth what someone with metal is willing to sell it for. And right now, that number is at minimum $125, with the Eastern floor sitting at 130 plus. Everything else is just noise, just manipulation, just desperate attempts to defend an indefensible pricing structure for a few more weeks or months. But the math always wins eventually. And the math right now says 105 is impossible to defend against physical delivery demand at current inventory levels. The question isn't whether the paper price eventually has to rise to meet physical reality. The question is only whether it happens smoothly through market forces or catastrophically through a delivery failure. I'm positioned for either outcome. Because either way, the physical metal I'm holding is worth a hell of a lot more than $105. The screen might say otherwise for a few more days or weeks, but the market, the real market where actual metal changes hands, already knows the truth. And in the end, the truth always wins. Even in silver markets, even against the bullion banks, even when the manipulation looks overwhelming in the moment, the truth is in the physical premium. The truth is in the delivery notices. The truth is in the inventory math. And right now, all 3 of those sources of truth are telling the same story. This isn't over. It's just getting started.